What the heck is an LLPA? It stands for Loan Level Price Adjustment. And it kind of sucks. And there's big changes coming. LLPAs affect the pricing for your interest rate. And pricing refers to the cost or credit associated with a given interest rate. Currently, LLPAs kind of make sense. If you have a lower credit score, if you're putting less down on your home purchase, Fannie and Freddie have an LLPA to increase the pricing on your interest rate. Think of it like this. The more the risk in lending the money, then the greater the LPA and or your interest rate is going to be. Makes sense, right? So now we have these new LLPAs coming from Fannie and Freddie. Boo. Now, I don't want to make this seem all negative. Pricing has always been higher on certain types of loans, like for an investment property, a second home, manufactured home, a condo. You get the point. So now it may make more sense for someone to use an FHA loan tomorrow, where it made more sense for them to use a conventional loan yesterday. FHA just lowering their monthly mortgage insurance, that can really help this be a win. So the new LLPA I really want to talk to you about today is the one that Fannie and Freddie are adding if your debt to income ratio is over 40%, which is kind of most of us. Debt to income ratio, or DTI, refers to the percentage of your monthly gross income versus your monthly minimum obligations for any debt that you have: house payment, credit card, auto payment. So if that is over 40%, that means this LLPA will be added, and there's not much we can do about that. But there also might be. Just like every other service-oriented business, not all loan officers or companies are created equal. It will now matter much more who you work with. Calculating your income is not simple or easy. It's not necessarily what your last paycheck shows or what you currently earn. Our industry requires us to review your history of your income. Sometimes that means we have to use a 2-year average. Sometimes it means I can't use things like overtime or bonus or commission if you haven't been receiving that income for a full 2 years. Sometimes if your overtime is less this year than last year, we have to lower that and go with the lower amount. And don't even get me started on self-employment income. So in the past, if you had overtime income or bonus income that we didn't need to use to qualify you, we kept it off the loan application. It was just easier, simpler for the underwriter to calculate, and we like to keep things simple for the underwriter. But now you're going to want to work with someone that knows how to find all of your income from every source that we can possibly document, so that we can work to keep that debt to income ratio under 40%, if at all possible. Change is life, and it certainly is in the lending industry. Protect yourself. Work with someone like me that you know is going to look at all the options to get you the best possible loan. And start early, so we got plenty of time to work up a game plan, and then you get to go home shopping. You can feel confident you've seen all the options, you know everything that is available to you, and when you write that purchase contract, it can be nothing but excitement. It matters who you work with.